For years, you've been told that Bitcoin is risky, it's speculative, it's a pet rock, a fraud, a Ponzi scheme. You've been warned by the financial establishment to only invest what you're willing to lose. But what if I told you that the very institutions that issued those warnings are now positioning themselves to get their hands on your Bitcoin? What if I told you your bank is starting to see Bitcoin as one of the most desirable forms of collateral in the world? They don't just want your dollars in a savings account anymore. They want your Bitcoin. This isn't a hypothetical future, it's happening right now. News broke recently that JPMorgan Chase reportedly plans to let its institutional clients use Bitcoin and Ethereum as collateral for loans by the end of this year, and they are not alone. Giants like Morgan Stanley, Fidelity, and BlackRock are all making significant moves into the digital asset space. For years, you've held on, believing in Bitcoin's long term value, but you've faced a frustrating problem. All that wealth is locked up. It's a powerful number on a screen, but you can't use its value to buy a car, fund a business, or make a down payment on a house without selling. And selling means two things you want to avoid: creating a taxable event and giving up your position in what could be a once in a generation appreciating asset. This video is about the seismic shift that solves that problem. We're going to break down exactly why the big banks have changed their tune, how this new financial tool, the Bitcoin backed loan, actually works, and most importantly, how it fundamentally changes Bitcoin from a speculative savings account into a productive, powerful asset for your financial future. The game has changed, and this is your new rulebook. So, why the sudden change of heart from Wall Street? Why is an asset once dismissed as a fringe fantasy now being welcomed into the core operations of global finance? The answer can be summed up in two words: pristine collateral. To a lender, collateral is everything. It's their safety net. When you take out a loan, the bank needs assurance that if you fail to pay it back, they can seize an asset, sell it, and get their money back. For centuries, assets like real estate, gold, stocks, and bonds have filled this role. But each comes with its own set of problems. Real estate is illiquid. Selling a house can take months and involves costly appraisals and legal fees. Stocks and bonds are better, but they only trade during market hours and are tied to specific jurisdictions. Gold is physically cumbersome and requires secure, expensive storage and verification. Now compare that to Bitcoin. For a lender, Bitcoin possesses a unique combination of properties that make it an incredibly powerful form of collateral. First, 24/7 global liquidity. Bitcoin markets never close. They are open 24 hours a day, 7 days a week, 365 days a year, all across the globe. If a borrower defaults on a loan at 3 a.m. on a Sunday, the lender can instantly sell the Bitcoin collateral on any number of global exchanges to recoup their funds. There is no waiting for the New York Stock Exchange to open. This dramatically reduces the lender's risk. Second, transparent and instant valuation. The price of Bitcoin is globally recognized at all times. There is no need to hire an expensive appraiser to determine its value as you would with a house or a piece of art. The market provides a constant, live price feed, which is critical for managing the risk of a loan. Third, easy and verifiable custody. With its cryptographic nature, ownership of Bitcoin is absolute and easily verifiable on the public ledger. While you, the borrower, would pledge your Bitcoin, a lender or a third party custodian can take control of it in a way that is cheap, efficient, and undeniable. Storing it doesn't require a massive vault, just a secure digital wallet. And finally, it is a bearer asset. Much like physical gold, a Bitcoin is a bearer asset. Whoever holds the keys controls the asset. It doesn't rely on another company's performance or a government's promise. It just is. This quality is what makes it so pure, but it's important to remember that as soon as you give it to a lender as collateral, you introduce counterparty risk. This shift is not just theoretical. JP Morgan's reported plan to accept Bitcoin as collateral is a landmark moment, signaling that digital assets have matured enough for global finance. When the world's largest bank, whose CEO once famously called Bitcoin a fraud, decides it's good enough to back loans, it forces every other financial institution to pay attention. We're seeing this with Morgan Stanley preparing to offer crypto access on its E-Trade platform, and the massive success of spot Bitcoin ETFs from giants like BlackRock and Fidelity, which have onboarded tens of billions in assets and laid the groundwork for deeper integration. This isn't just a few rogue companies, it's a coordinated pivot by the pillars of the financial world. They recognize that denying the utility of this new asset class is no longer a viable business strategy. The idea of borrowing against your assets isn't new. For decades, homeowners have used home equity lines of credit, HELOCs, to tap into the value of their property without selling it. A Bitcoin backed loan operates on a very similar principle. You're not selling your Bitcoin, you are simply pledging it as security to unlock its cash value. So, how does this actually work? Let's break it down with simple numbers. Imagine you own one Bitcoin and its current market price is $100,000. You need $40,000 for a down payment on a house, but you absolutely do not want to sell your Bitcoin. You believe it will be worth much more in the future, and selling would force you to pay a hefty capital gains tax on your profits. Instead, you go to a lender, which could be a crypto native company or increasingly a traditional bank, and apply for a Bitcoin backed loan. The first and most important concept you'll encounter is the loan to value ratio, or LTV. This is the percentage of your collateral's value that the lender is willing to give you as a loan. 20% to 50%. Lenders don't offer 100% LTV because of Bitcoin's volatility. They need a buffer to protect themselves if the price drops. This is called over-collateralization. So with your $100,000 of Bitcoin and a 40% LTV, you can receive a $40,000 loan. You transfer your Bitcoin to a secure address controlled by the lender or a third-party custodian. You then receive $40,000 in cash or stablecoins, which you can spend as you wish. The crucial part is this: you still own your Bitcoin. You retain full exposure to its price movements. If Bitcoin's price doubles, the value of your collateral doubles. Now let's talk about the two most critical risk factors for you: the borrower, margin calls, and liquidation. This is where the volatility of Bitcoin comes into play, and it's something you must understand completely. Let's say the lender has a liquidation threshold at an 80% LTV. Your loan is for $40,000. Right now, your collateral is worth $100,000, so your LTV is a healthy 40%, $40,000 loan, $100,000 value. But what happens if the price of Bitcoin starts to fall? Let's say the price of Bitcoin drops to $60,000. Your collateral is now worth $60,000. Your LTV has risen to roughly 67%, $40,000, $60,000. You're getting closer to the 80% threshold. At this point, the lender will likely issue a margin call. This is a warning. The lender is telling you that your collateral is no longer sufficient to safely cover the loan. You have two options: add more collateral. You can deposit more Bitcoin into the collateral address to bring the LTV back down to a safe level. Pay down the loan. You can use cash to pay back a portion of the $40,000 loan, which also lowers the LTV. If you ignore the margin call and the price of Bitcoin continues to fall, you face the ultimate risk: liquidation. If the price of Bitcoin drops to, say, $50,000, your LTV hits the 80% trigger. $40,000 divided by 50,000. At this moment, the lender's automated systems will immediately sell a portion or all of your Bitcoin on the open market to repay the $40,000 loan plus any accrued interest and fees. This is the lender's non-negotiable protection. It's what makes them comfortable lending against such a volatile asset in the first place. For you, however, it means your Bitcoin is gone, sold at a market bottom, and you've lost your long-term position. This is the single biggest risk of a Bitcoin-backed loan and why it requires active management. Interest rates on these loans can be competitive, though they vary widely depending on the platform, LTV, and market conditions, often ranging from under 5% to over 10% APR. Unlike a traditional mortgage, many of these loans are interest only, meaning you just pay the interest until you decide to pay back the principal in one lump sum to reclaim your Bitcoin. Understanding the mechanics is one thing, but grasping the strategic implications is what really changes the game. For over a decade, the primary narrative around Bitcoin was HODL, hold on for dear life. It was positioned as digital gold, a static store of value that you buy and lock away, hoping its value appreciates. The emergence of a robust lending market transforms this narrative. Bitcoin is no longer just digital gold, it's becoming digital real estate. It's an asset you can use and borrow against. It has evolved from a passive saving tool into a productive asset. This unlocks three game-changing advantages for the savvy holder. First, and most obviously, is accessing liquidity without selling. This is the solution to the core problem we discussed at the beginning. You no longer have to choose between keeping your Bitcoin and having cash for life's major expenses. Need to start a business? Renovate your home? Make a major investment? You can now use the value of your Bitcoin to secure the capital you need, all while your original Bitcoin investment remains intact, ready to capture any future upside. It bridges the gap between your digital wealth and your real-world financial needs. The second advantage is where things get really powerful: tax efficiency. This is a strategy the ultra wealthy have used for generations with their stock portfolios and real estate holdings. When you sell an appreciated asset, you trigger a taxable event. If you bought Bitcoin at $10,000 and sell it at $100,000, you likely owe capital gains tax on that $90,000 profit. However, in many places like the US, taking out a loan is not considered a taxable event. When you take out a $40,000 loan against your Bitcoin, that cash is generally not considered income, and you owe zero tax on it. This allows you to use your wealth far more efficiently. Of course, tax laws vary significantly by country, so you should always consult with a local tax professional. The third advantage is maintaining your long term position. Every long term Bitcoin holder lives with a certain fear, the fear of selling too early. Stories are legendary of people selling their Bitcoin for a few $1,000s only to watch it rocket to tens of thousands more. By borrowing against your Bitcoin, you solve this dilemma. You get the cash you need today while keeping your stack intact. You don't have to time the market. You simply use your long term holding as a source of ongoing liquidity, confident that you won't miss out on the next big wave of appreciation. It allows you to be both a patient, long term investor and an active participant in the economy. This combination of benefits represents a fundamental change in how we can think about saving and wealth management. Your Bitcoin is no longer just money sitting in a vault, it's the foundation upon which you can build, borrow, and grow, all while staying fully invested in the asset itself. This all sounds incredibly powerful, and it is, but this isn't free money, and we have to be brutally honest about the risks. These are sophisticated financial instruments, and if you misuse them, you can suffer catastrophic losses. The number one risk, which we've touched on but must emphasize again, is volatility and forced liquidation. Bitcoin is famously volatile. A 30% drop in a single day is not unheard of. If you take out a loan with a high LTV, say 50%, a sudden market crash could trigger a liquidation before you even have time to react. You could wake up one morning to find that a flash crash liquidated your entire position at the worst possible price. This is not a passive set it and forget it strategy. You must be prepared to actively monitor your LTV and ideally borrow conservatively with a low LTV to give yourself a wide buffer against market swings. The second major risk is counterparty risk. Who are you giving your Bitcoin to? When you take out a loan, you are transferring custody of your Bitcoin to a third party. This introduces a massive element of trust. In centralized finance, CEFI, you are trusting a company. The crypto space is littered with the ghosts of failed lenders like Celsius and BlockFi, who took customer deposits and went bankrupt, leaving users with devastating losses. As the saying goes, not your keys, not your coins. If the platform holding your collateral goes under, you may never see your Bitcoin again. In decentralized finance, DeFi, you might use a smart contract-based protocol. This removes the company risk, but replaces it with smart contract risk. A bug or a hack in the code could allow an attacker to drain the protocol of all its funds, including your collateral. While DeFi aims to be trustless, you are still trusting the integrity of the code. The third risk is interest rate and term risk. While some loans have fixed rates, many have variable rates that can change with market conditions. A sudden spike in interest rates could make your loan much more expensive than you initially planned. You need to read the fine print of your loan agreement carefully. Is the rate fixed or variable? Are there hidden fees? What are the exact terms of repayment? Finally, there is regulatory risk. The rules governing cryptocurrencies and crypto lending are still being written. A new law or regulation in your jurisdiction could change the tax implications of these loans, or even the legality of the platforms offering them. This is an evolving landscape, and you need to stay aware of the legal framework surrounding these products. Ignoring these risks is a recipe for disaster. Using your Bitcoin as collateral can be a powerful wealth building tool, but only if you approach it with caution, education, and a clear understanding of what can go wrong. So, with all of this in mind, I'm curious to hear from you. What are your thoughts on using Bitcoin as collateral? Is this a financial game changer that unlocks the potential of your holdings, or is the risk of liquidation just too high? Let me know your honest opinion in the comments below. I read every single one, and if you're getting value from this breakdown, do me a huge favor and hit that like button and subscribe to the channel. It tells the algorithm that this deep dive was useful, and it ensures you won't miss our next video exploring how this technology is changing the world of finance. The narrative is clear. The financial world is undergoing a profound transformation, and Bitcoin is at its center. The reported decision by behemoths like JPMorgan to formally recognize Bitcoin as loan collateral is not just another news story. It's a validation of Bitcoin as a serious, mature asset class. For years, the institutions told you it was a worthless novelty. Now they are openly signaling they want it on their balance sheets. This shift does more than just validate your investment. It equips you with a powerful new tool. The ability to borrow against your holdings transforms Bitcoin from a passive, speculative asset into a dynamic, productive engine for wealth creation. It offers a path to liquidity without the penalty of taxes and without the regret of selling too soon. It's a strategy that allows you to live off your wealth, not just watch it grow on a screen. However, this new power must be wielded with wisdom and respect for the risks involved. The volatility that creates so much opportunity also presents the danger of liquidation. The platforms that offer these services require a level of trust that should not be given lightly. This isn't just about getting a loan. This is about the financialization of Bitcoin, turning it from an asset you simply own into an asset you can use as the foundation for a new kind of wealth management. The game has changed, and for those who have held on with conviction, the new rules are finally starting to work in your favor.